The global financial system, the intricate network of banking, credit, and monetary policies upon which modern civilization rests, is precariously balanced on the edge of an implosion. This instability arises from an unsustainable imbalance, the staggering $93 trillion in debt, contrasted against a mere $20 trillion in actual circulating currency. This discrepancy illuminates the core issue of our monetary system. It is not money in the traditional sense of being a tangible, effort-based store of value, but rather an abstract construct. The currency we use today is created out of thin air through debt issuance, a process that inherently lacks permanence or intrinsic value. If confidence in this system falters, whether through distrust in the currency or the broader banking infrastructure, the consequences will cascade through society, disrupting the foundations of trade, savings, and daily transactions upon which the modern world depends. The fragility of the system reflects not only its design flaws, but also its dependence on public trust, which can evaporate far more quickly than it was built. Central to the system's function is its insatiable need for constant expansion. This is because the currency supply must perpetually grow to cover the interest on existing debts. In a fiat currency system, every loan issued generates new currency, but this currency is ephemeral, extinguishing as the loan is repaid. For example, when an individual takes out a mortgage, a bank creates money electronically and deposits it into the borrower's account. This newly created money is then used to purchase a property or fulfill the loan's purpose. Over decades of repayment, the principal portion of the loan vanishes from the monetary system as the debt is extinguished. This dynamic means that currency is in a continuous cycle of creation and destruction, rendering it incapable of acting as a long-term store of value. Moreover, the system necessitates the creation of ever-increasing amounts of debt just to sustain itself, leading to an accelerating spiral of borrowing and repayment. One particularly ominous development is the potential introduction of central bank digital currencies, CBDCs. These digital currencies, if implemented universally, would eliminate alternatives such as cash or decentralized financial options, effectively trapping individuals within a closed loop system entirely controlled by central banks. Such a system would grant governments unprecedented surveillance and control over individual financial activities. Negative interest rates, which penalize savings, could be imposed at will, compelling consumers to spend their money or watch its value erode. Taxes, already rising to cover the ballooning interest obligations on national debts, would further increase, perpetuating the cycle of deeper indebtedness for both individuals and nations. CBDCs represent not merely a technical evolution of currency, but a potential paradigm shift that could redefine personal freedom and economic sovereignty. The fragility of the financial system is starkly revealed during crises, such as bank runs and financial institution collapses. Bank runs, historically fueled by fear and uncertainty, have become even more instantaneous in the digital age, where withdrawing funds requires little more than a smartphone and a text message. This rapidity exacerbates systemic vulnerabilities, as the entire banking structure operates on fractional reserves, meaning that banks hold only a small fraction of their depositors' money at any given time. If too many depositors demand their funds simultaneously, the bank and potentially the broader financial system faces collapse. Such events starkly expose the illusory nature of the system, where solvency is maintained not through tangible assets, but through the perception of stability and confidence. Amid this tenuous backdrop, the role of gold resurfaces as a curious anomaly. While fiat currencies dominate global economies, central banks worldwide have been quietly amassing gold reserves at unprecedented rates. Gold, a Tier 1 asset regarded as the safest and most reliable store of value, sits in stark contrast to the ephemeral nature of modern currency. China, the world's largest gold producer, has also become its largest importer, hoarding vast quantities of the metal while prohibiting its export. This strategic accumulation suggests preparations for a potential shift in the global monetary framework. Gold's enduring value, tied to its physical scarcity and universal acceptance, positions it as a hedge against the inherent instability of fiat systems. As central banks bolster their reserves, the message is clear: a significant monetary disruption looms on the horizon. The interconnectedness of the global economy further compounds these risks. In the past, economic downturns spread gradually through trade networks, with countries experiencing recessions sequentially over years. Today, the speed and complexity of financial markets, driven by derivatives and digital transactions, ensure that crises propagate instantaneously. A financial collapse in one nation, whether triggered by debt defaults, currency devaluation, or banking failures, reverberates across the globe. The 2008 financial crisis, sparked by the U.S. subprime mortgage market, demonstrated the cascading effects of interconnected markets, and the lessons from that era remain unheeded. The vulnerabilities in today's system are amplified, not mitigated by technological advancements. One of the primary architects of the current financial environment is former Federal Reserve Chairman Ben Bernanke. His 2002 speech, Deflation, Making Sure It Doesn't Happen Here, outlined a roadmap for navigating economic crises when traditional monetary policy tools, such as lowering interest rates, become ineffective. Bernanke proposed unconventional measures, including quantitative easing, QEA, process where central banks purchase assets to inject liquidity into the economy. These policies were implemented during the 2008 crisis, temporarily stabilizing markets but leaving underlying issues unresolved. The intervention prevented a natural market correction, inflating asset prices beyond sustainable levels and creating what has since been termed the everything bubble. By artificially propping up stock markets, real estate, and bonds, QE deferred the reckoning rather than addressing its root causes. Today, the Federal Reserve finds itself constrained by the very policies it implemented to avert past crises. The Federal Reserve Act restricts the creation of currency to specific asset purchases guaranteed by the U.S. government. While this legal framework ostensibly prevents reckless monetary expansion, it has not stopped the accumulation of unprecedented levels of debt or the proliferation of financial bubbles. With interest rates now rising, the consequences of years of artificial market support are becoming evident. Housing markets, once buoyed by low borrowing costs, are beginning to crack under the weight of higher mortgage rates. Stock markets, inflated by years of cheap money, face increased volatility as investors reassess risk. The real economy, where wages and productivity lag behind asset inflation, bears the brunt of these imbalances. The broader public remains largely oblivious to the intricacies of the monetary system, including the dual forms of currency in circulation. Bank credit, created through lending, constitutes the majority of the money supply and drives consumer and business activity. In contrast, base currency, created by the Federal Reserve and existing primarily as bank reserves, operates within a separate monetary sphere. This division obscures the true nature of monetary policy and its impact on everyday life, leaving the average citizen ill-equipped to navigate or challenge the system. As the global financial system inches closer to a tipping point, the signs of an impending reckoning become increasingly difficult to ignore. Record levels of debt, unsustainable asset bubbles, rising inequality, and the looming specter of CBDCs all point to a period of profound transformation. Whether this transition will lead to a more equitable and stable monetary framework or exacerbate existing disparities remains uncertain. What is clear, however, is that the current trajectory is untenable. The forces driving the system's expansion are the same forces sowing its destruction, a paradox that underscores the fragility of the foundations upon which modern economies are built. In this volatile landscape, individuals, institutions, and nations must prepare for a future defined by uncertainty, disruption, and the urgent need for innovation.